If you're looking for a portfolio that lets you grow your wealth without the heart attack volatility or pure stock funds, XBAL is likely your top contender right now. It's the so-called balanced flagship from iShares designed for the investors who want a smoother ride but don't want to settle for the tiny returns of a savings account. By combining global stocks with a heavy dose of bonds, this fund aims to capture the market's upside while also keeping your portfolio from swinging wildly during economic turbulence. While the 60-40 split is a classic strategy, many modern investors wonder if it still holds up in today's fast-moving world. So today we're doing a deep dive into XBAL. We'll check out the XBAL Holdings, see how the XBAL MER stacks up against its biggest rivals like VBAL, and look at the XBAL dividend structure to see how this fund handles the payouts. So without further ado, let's get right into it. So what is XBAL? Officially, should we say, it's the iShares Core Balanced ETF portfolio. To simplify it, it's a one-ticket solution that automatically splits your money into roughly 60% stocks and 40% bonds. It's a fund of funds, meaning when you buy XBAL, you're actually buying a slice of several other specialized iShares ETFs. These underlying funds cover the entire world, including the US total market, Canadian large caps, and international stocks from Europe and Asia. The fund is really built for set-it-and-forget-it kind of investor who values simplicity above everything else. BlackRock's managers do all the heavy lifting for you. They monitor the markets and automatically rebalance the fund for you. If stocks have a massive run, they'll sell some of those gains to buy more bonds, for example, keeping it at perfect 60-40% ratio. And this prevents your portfolio from becoming too risky over time if the stocks have a great run, for example, and save you from having to do the math yourself or doing any extra trading to fix it yourself. So let's do a little comparison now. The biggest question most Canadians have is XBAL versus VBAL. Both are absolutely excellent, but they have very slight differences in their flavor, shall we say. The XBAL MER is generally among the lowest in the industry, often coming in slightly cheaper than Vanguard's version. And while the difference is minuscule, but for long-term investors, every basis point saved on these fees means more money staying in your portfolio and compounding. XBAL also tends to tilt a bit more towards the US stocks, whereas VBAL typically keeps a slightly higher percentage in the Canadian market, similar to XEQT and VEQT. Then there's the internal choice. XBAL versus XGRO. XGRO is 80% stocks, meaning it will grow faster in a bull market, but drop much harder when things go south. It's built for people with decades of time left before they need the money. XBAL is 60% stocks, making the perfect choice for those with a medium risk tolerance. And for the person who wants to see their account grow, but really doesn't want to panic sell when they see red in the news. By keeping 40% in bonds, you can think of it as XBAL providing a ballast of some sort that keeps the ship steady during a storm or a big downturn and makes the ride a little bit smoother. Okay, let's look at the holdings now. When you look under the hood, you see why it's so stable. The equity side is well diversified, holding thousands of companies across essentially every sector, from obvious tech giants in Silicon Valley to the big banks and energy companies right here in Canada. By spreading your money across different countries and sectors, XBAL ensures that your success isn't tied to the economy of just one nation. If the Canadian dollar or the TSX struggle, the international and US portions are there to pick up the slack. And the secret sauce of the fund is the 40% fixed income side. It holds high-quality government and corporate bonds that generally pay a steady stream of interest. This bond cushion is what prevents the XBAL price from cratering when the stock market has a bad month or a bad year. Historically, when stocks go down, bonds often hold their value or even go up, which creates a rebalancing bonus that can help boost your long-term returns compared to just holding one or the other. Now let's talk about the dividends. For many investors, the XBAL Dividend is the cherry on top. Because the fund holds both dividend-paying stocks and interest-bearing bonds, produces a very consistent stream of cash. XBAL pays out quarterly, with payments hitting your account 4 times a year. This makes it a popular choice for people who are nearing retirement, for example, and want a somewhat predictable payout, or for younger investors who want to reinvest that cash to speed up their growth. While the specific yield changes, always based on the market, XBAL is known for providing a pretty reliable distribution. Most investors simply choose to set up a DRIP, which is the dividend reinvestment plan, through their broker, and this way your quarterly cash is automatically used to buy more shares of XBAL without you having to log in, make a trade, anything at all. Everything is done for you. And over the years and decades, this automatic buying can significantly increase the total number of shares you own and truly accelerate your path to financial freedom. Okay, so should you put the trigger on XBAL? Well, if you want a portfolio that grows steadily and lets you sleep through a recession, I would say it's really one of the best tools available to Canadian investors. It's officially a core holdings for many couch potato style portfolios where it strikes a near perfect balance between the risk and reward. Here's what I'm gonna say. I say you should choose XBAL if you have a medium risk tolerance and you're within, let's say, 10 to 15 years of needing your money, or you just want a smoother ride than an all stock portfolio provides. Then I'm gonna say that you should choose XGRO or XEQT if you have a very long timeline still and you don't mind seeing your balance drop 20% or more in a bad year and you want to maximize your total long-term growth. Unless I would say choose VBAL if you're already a Vanguard fan and you prefer their slightly higher allocation to Canadian stocks and global bonds. Thank you guys for watching this video. Just a quick heads up, as always, this video is for educational purposes only. I'm not a financial advisor, just a guy sharing my own research and opinion. So please do your own homework and research before moving your money around. And if you enjoyed the video, please hit the like button and subscribe to the channel. It honestly helps the YouTube algorithm realize that these videos are at least somewhat watchable, and I'm actually bringing a tiny bit of value to the personal finance community, which means the world to me. Anyways, thank you guys so much for your support once again, and I'll see you in the next one. Take care.